Hello and welcome to today's NinjaTrader ecosystem event, Option Trading with AI. My name is Patrick Hodges and I'm a NinjaTrader ecosystem vendor relations representative. Before we start the webinar here today, I have a few housekeeping notes for everyone. Secondly, this webinar is presented by NinjaTrader LLC, which is the technology company responsible for developing and supporting the NinjaTrader trading software. Brokerage-related questions should be directed to the NinjaTrader brokerage, which you can use the phone number or the email that you see on screen. I've also entered them into the chat room if you need it. Lastly, if you are new to NinjaTrader, please make sure to sign up for a free NinjaTrader account, which includes access to 14 days of complimentary real-time market data. Our platform is always free for advanced charting, strategy backtesting, and trade simulation. You can create your free account by following the link on the screen and then clicking the Get Started option under the Welcome section. Now, before I turn the mic over to Ophir, it's important to understand that futures, foreign currency, and options trading contains substantial risk and is not suitable for every investor. It is possible to lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. Also, please remember that these training sessions are not a solicitation nor a recommendation, but simply educational in nature. I want to thank everybody again for joining us today. And without further ado, it's my pleasure to welcome to the NinjaTrader webinar room, Ophir. Go ahead and take it away, Ophir.
All right. I'll share my screen. Hello, everyone. Thanks for joining. Happy Thursday. I hope everyone is doing well. I have a quick slideshow, and then I'm going to show you a portfolio of option trades. But before then, I'm going to talk about maybe some things that are, let's say, irritating your trading progress. First, let me do some disclaimers. Patrick did them, and I got to do them. So the results here are provided for general information purposes as a convenience to you, the viewers. The materials are not a substitute for obtaining professional advice from a qualified person, firm, or corporation. One more slide. This is not a solicitation to buy or sell any security ever. This is not advice. Past performance is not necessarily indicative of future results. That goes for all of life, by the way, not just trading. You should read the characteristics and risks of standardized options available on the OCC website. Okay, this is the agenda. We just did the agenda slide. I'm going to talk about trading generally. Okay, this is nothing about a product I'm selling or a software I'm selling or my AI. This is just trading generally. I think if you're having trouble with success trading, broadly speaking, I'll bring up 3 things that I think you have to have. It's not my software. 3 things you have to have to be a successful trader. I am a former hedge fund manager. I am a former option market maker on the NYC ARCA and CBOE exchange floor. I'm a former managing director of quantitative research, and there's more than $1 trillion in assets under management and models that I've created. Okay? So this is what I've learned from trading generally before I talk to you about anything else. All right, so let's talk about that. As I said, if you've not had success, there's a chance it's mistakes here that explain your performance. All right, so great. Let's do it. For those of you that have followed me on TV or with my company throughout the decades, you've heard me say that for a successful trading career, I'm talking about the long arc of a career, like not Thursday and not next week and not, in Jackson Hole. I mean, 9 or 10 months out of a year. I mean, 9 out of 10 years. For the long arc of a career, I believe that option traders need a portfolio of trades. Okay, great. What's a portfolio of trades? That's a good question. I'm glad you asked. You will need long volatility. If you don't know what long volatility is, that's okay. It just means being long options. Like a debit, buy a call spread, something like that. You also need to be short volatility. If you don't know what short volatility means, that's okay. It means being short options. Let's say selling a put spread, something like that. You're going to need to know how to work in 4 markets. A lot of people who are not traders think there's only 2 markets. There's a bull market and a bear market. And as a trader, you know very well that there are 4 markets. So you got to have strategies for a bull market and you got to have strategies for a bear market. But more times than not, it's neither a bull nor a bear we're dealing with as traders. We're dealing with going in between a bull and a bear. So that's a recovering market. It's going from a bear to a bull, or a falling market going from a bull to a bear. In less than 20 minutes, you're going to have all of this. So this is a preamble. It may seem esoteric. I'll make it very explicit and hands-on. But broadly speaking, this is what I mean by a portfolio of trades. Now, since I'm going to be sharing an actual portfolio of alerts, an actual portfolio of trades, okay, that's my job. You also have a job. And I'm going to tell you your job. So very early in the webinar. So if you don't want to do your job, you don't have to listen to me anymore. You can go enjoy your Thursday. Right? Your job is this. A lot of people say they want to do something. But what they really mean is they like the idea of doing something. And if you don't know what I mean by those two, I'll make it really clear. All of us as humans have thoughts that make us happy. I don't know, we want to run a marathon. We want to climb Mount Kilimanjaro. I don't know, we want to be successful traders. We want to bench 350 pounds. I don't know. We want to be better parents, whatever it is, okay? That's called being human, letting our minds think of things that make us feel better, because oftentimes life is miserable. Now, the difference between liking the idea of doing something and wanting to do it is this. If you have those really positive thoughts and you get a warm feeling in your belly and you feel good, but you never really do anything to pursue it, then you like the idea of it. And I just want to be clear, there's nothing wrong with that. You should like the ideas of lots of things, right? That's kind of the spice of life. That makes our minds not tortured. Okay, but I'm not here to be existential. I'm here to talk about trading. So I'm talking about trading, not being a good parent or Mount Kilimanjaro or a marathon or benching 350 pounds. So the difference between liking the idea of something and liking the idea of something and wanting it is that you not only have the positive thoughts, but you then take steps to do it. So you like the idea of a marathon. It means you like thinking about it and running, but you never do it. You want to do it, then you think about it and you start training. So that's it. So in my opinion, if you want to be a successful trader and you're able to disentangle the difference in your own mind between wanting something and liking the idea of it. And by the way, either one is fine. There's nothing wrong with liking the idea of things. Almost all of us like the idea of things more than we want to do things, which is like it just makes us feel good. Now, if you really want to be a successful trader, then you will be focusing on the following three things, and you'll very clearly see right now at the end of the slide where you fall. Because if I show you these three things, and you say, "Yeah, that's cool, no thanks," then you don't want it, and that's okay. Don't do it because you don't want to be trading if you don't really want it. Because this is a thing that can actually make you lose money, right? You're not going to really hurt yourself if you think about being a marathon runner and you do it once, you're like, I forget it, I quit. Okay, you're not going to hurt yourself. This you can actually hurt yourself. Here's what you need: it's three things, and three things only, I think. First is a process. In finance, we call it a plan. And with this plan, you need to write it down. You don't think about the plan. You don't kind of jot it down on a piece of paper or scratch, email to yourself. You write it down step by step. A plan is written down clearly and explicitly such that some other human could come into your brain and read it and know what you meant. Second thing is you're going to need patience. That's with the plan and with yourself. Okay. So for some people, this is a total triviality. They're just like, yeah, of course. And they're blessed people. Patient people are blessed people. I am not patient. This was the hardest thing for me. I'm a Stanford trained mathematician, financial mathematician. I've run huge models. Patience was the hardest thing for me in trading. It just was. So know thyself. Patience is either the hardest thing or the easiest thing, but it's only the hardest or the easiest thing. So for those of you that are blessed with patience, you know, it's a really good character trait. And if you're blessed with impatience like me, then we have work to do. And the third thing you'll need to be a successful trader is effort. And I have some good news for effort and some bad news. So I'm going to start with the bad news because I like to finish on a good note. The bad news about effort is that it's probably not going to be as easy as you want it to be. So if you're like, yeah, I want to be a trader and I want to have a plan process and I think I can learn or I have patience and I want to put in the effort, it's probably going to be harder than you think. That's the bad news. Here's the good news. It's also probably going to be more satisfying than you think. And the reason it's going to be more satisfying than you think is because it's harder than you think. Those two go together. Welcome to humanity. These are the three things. If at this point in the webinar, you think, I don't want to do any of those three things, I think I've saved you money. Stop trading. And I don't mean that as a derision. It's just not worth it. Go do something else with your life. Go be a mother or a father or a brother or a sister, or a friend, a neighbor. Go do that. Go do something else with your life. If you want to be a trader, this is what it takes. And it's going to be harder than you think it will be. But it will be more satisfying than you think it will be too. This is the difference between wanting to do it and liking the idea of doing it. I can't do a whole lot about the middle bullet. This webinar will be bullets 1 and 3. I can't do a lot about patience. If I had more time, this is a very limited time webinar, I would talk to you a lot about patience and kind of overcoming it, but that's not the time we have together. Okay, so this is kind of on you. Okay, and this is my confession. This was my hardest thing. This was my hardest thing. And I've done some hard things in my life, but this was the hardest one, patience. So I said, you have a job. So what's your job? Well, your job is effort. This is your job. I said, my job is to show you a portfolio of trades, to define it, to show you through that definition what it is, to give you a plan, to help with your effort. But ultimately, this is your job. I've defined my job. I've defined your job. That's it. The goal is to have a portfolio of trades that historically do better at different times of market cycles. That's a bull market, a bear market, going from a bull to a bear, going from a bear to a bull, because there's actually 4 markets if you're a trader. And if you're a trader and you're listening to this, you're probably nodding yes, right? It's not a bull market and a bear market, it's 4 markets. And the goal is to make it so that the long arc of your trading career is successful. There's something magnificent about the financial freedom of being a professional trader. There's also something terrible about it because it takes a lot of effort. Up to you what you want to do. Okay, so what is a portfolio other than those bullet points I showed before? Well, I'm going to show you a strategy called spread the sell-off with AI. This is for a bear market. A few industries. There's something called buy the sell-off with our AI. That's for a recovering market. So we're in a bear going back into a bull. There's just a straight down the middle bull market. Things are going up. Stocks are over their 50-day moving average. There's a pre-earnings momentum diagonal with AI. And the fourth thing in a portfolio of trades, at least for mine, is something called fade the dip. Okay, it's when a stock is recovering. It's in technical failure and it's recovering. So that's it. Those are just words for you right now. They shouldn't mean very much to you at all. But this is going to be hands-on. But just so you know what's coming, tell them what you're going to tell them. Tell them what you told them. I'm telling you what I'm going to tell you. 4 strategies. This is a portfolio of trades. And why is it a portfolio of trades? Because you're going to say, no, you already defined what a portfolio of trades is. That's right, I did. I said different markets, up, down, recovering, falling, different types of trades, selling volatility, buying volatility, mostly spreads. Those are all color-coded. And in different sectors. This is a portfolio of trades. You don't have to memorize this slide. There's far too many colors. Anyone who's like a communications major would look at this and be like, dude, you have too many colors. There's too many colors, like squiggly things. It's okay. This is what a portfolio of trades is. I'm going to show you exactly what it is. I'm going to show you exactly how it's done. Okay. We're going to use back testing at the core of what we do. We're going to lean heavily on our proprietary AI. I am published in AI in academic journals and also in models which are run by some of the largest institutions in the world. We're going to look for strong results in a sector first. So it has to work in the sector first overall. Then, if and only if it works well in the sector, will we be willing to look for the best performers in that sector? We will not just look for best performers, because if it doesn't work in the sector, then you're just cherry picking and there's probably no statistical significance. Okay? If that didn't make sense to you, I'll say it like this. If the strategy doesn't work for the sector, there's no reason to believe that you can cherry pick names out of the sector for it to work. That's all I'm saying. All right, now, real quick, our AI, what is it? Why does it matter? What is this AI thing we do? Well, there are ways a stock moves, and this movement can be plotted like daily returns, like the stock goes up 0.60%, then it's down 0.52%, blah, 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 blah. Okay. And these numbers, when you take a magnifying glass to them, they have characteristics that matter. Okay. Like are there large moves? Are there large moves up? Are they down? Are they more often up? Are they more often down? What's the frequency? In stats, we just kind of call that tail behavior. And if we get really funky, we call it kurtosis. That's one characteristic of these things. Another characteristic is whether they're just positive or negative. We call it symmetry or really asymmetry. Right? And that has a kind of fancy name in measure theory. It's called skew. Yeah, just jargon. Yeah. Are there lots of big moves? Are they up or down? Are they mostly positive days or negative days? Is it asymmetric? That's what the AI looks at. And we discovered that if you take AI and point it at the stuff you see under the magnifying glass, so those things I was just talking about, it does come in patterns. And then these patterns repeat and have repeated for decades through several different markets: bull markets, bear markets, recovering markets, and falling markets. And our AI captures these patterns and turns them into a signal. The good news is you don't need to know the details. So I did once do a webinar where I really talked about these things in great detail, and some people loved it, and some people were like, can you just like show me how to use it? And I thought that was a really fair answer, and I realized I gave a webinar as a mathematician rather than a trader, and that wasn't very helpful. So I'm not going to do that again. In TradeMachine, when you see this little AI with a lightning bolt, that means that while it might be a good backtest, blah, 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 our AI has also triggered. Okay, it's an and. You'll see what this means. This is just a slideshow. I'm going to show you TradeMachine. And why should you care? And that is a question you should be asking, because I just said a lot of words, but I think ultimately the response to my words is, yeah, okay, so what? And it's because of the results. That's why you should care. So I'm going to show you an 8-minute video, because when I actually did this and explained it, it took me like an hour, and we had very, very little time together. So I made an 8-minute video for you. So I'm going to make that. I'm going to pull that video up on my screen right here. It's on YouTube. I'm going to play an 8-minute video. And I hope I'm sharing my sound. You know, guys, I'm going to stop sharing for a second, and then I'm going to share again. I'm going to go away for a second, my video, and I'll be right back. Stop share. I'm still here. Don't worry. Share sound. Okay. All right. I am sharing my sound. Okay. So I'm going to play this video for 8 minutes, because otherwise it's like an hour presentation. So here I go. And yes, there's music, so it's going to be a little weird. I know. I'm live on a webinar now. I'm playing a video. I got it. We don't have a lot of time, so I want to make sure everyone gets something from this webinar, not just that I'm, just selling software. Okay. So here comes the video. To help you trade better by using advanced statistical concepts and implementing them directly into trading, we will use historical results. We're going to be implementing AI. That's several different types. We will talk about return distribution characteristics designed for those who have no experience in statistics at all. So that means specific use cases in return distribution characteristics, in particular, something called kurtosis. You don't have to know what it is. Something called skew. You don't have to know what that is and why it matters. So tail events are very rare in normal distributions, but in finance, they're much more frequent. So we see fatter tails, much fatter tails than people realize. PIMCO said that, and you always want to look at the fixed income guys for conversations and discussions on tail risks, because the only risk they face is tail risk. But there's also the tail of the tails. So tail risk, and then the really edgy stuff in the tails. We're going to talk about that too. So if you're listening to this, and you are, you could be saying, that's true. I'd like fatter tails on the upside for a bullish bet, or I'd like skew leaning positive skew, or both. It makes sense. It's a logical argument. You haven't proven it to me yet. So I want to be clear. I have not demonstrated that it matters yet. That's what I'm going to do now. I'm talking about the fatness of the tails. We can call it kurtosis. And I'm talking about the asymmetry in the return distribution, or skew, if you like. So why does it matter? So the first thing I'm going to do is motivate it with stock returns. Then I'm going to motivate it with win rates on option trades. I'm going to motivate it with win rates and returns on successful option strategies already in TradeMachine. And I'm going to use statistical significance as our backbone. Let's motivate it with stock returns. If we took the constituents of the S&P 500 in 2018, and I said, I want to see the average one-year return for every stock in that group from June 2018 to June 2023. 1 year return, every single stock in the S&P 500. The win rate, which is simply measured as were the returns positive or negative, was 59.4%. That makes sense. Stocks go up in general, in particular large caps. The average 1 year return was 10%. This is not me doing anything. This is observational. Then I said, well, what if we took a measure of kurtosis, which I'm not going to tell you exactly how we did it. It's not just the return distribution. And I just said it was greater than 1. This is already standardized for the normal. And the average return went from 10% to 13%. The win rate went from 59% to 63. There was a 99.9% statistical significance. So what that means, there is a 1 minus 99.9% chance that we would find these results as they are, and that it would be random. 0.1% chance. Okay, let's say I said, that's interesting. What if I took, do you remember when I said the tail of the tails? Remember that? The tail of the tails? What if I said the tail, the upside kurtosis, the net kurtosis, was greater than 3? And again, for those of you that are statisticians, that'd be greater than 6. It's relative to the normal. All of a sudden, the win rates went from 63.1 to 63.9. The average return went from 13% to 15%. Statistical significance rose. Now, I'm only talking about the tails so far, right? I'm not talking about the asymmetry of returns. I haven't talked about skew. Well, let's do that. Okay, I'm not going to go through everything, but here's the last one. What if I said, well, what if I took the tail of the tails, took the 1-year kurtosis, is greater than 3. I took the medium-term skew, 6-month greater than 1, and the 1-year skew greater than 2. So I took the tails of the tails, and I took asymmetry. Win rate went from 59% to 66%, and the average trade went from 10% to 20%. Very strong statistical significance. So look, as we kept adding return distribution characteristics, how the win rates went up and the returns went up. So remember this. Remember when I said I have not demonstrated that it matters. All I have done is demonstrated why it might matter. Now for stocks, I have demonstrated that it matters. The trading strategy was a triviality. There's nothing special I did here. I checked the skew and kurtosis for each stock in the S&P 500, and if it qualified, I held the stock for a year, and I did nothing else. It's the results that are not a triviality. So I want you to imagine your win rates rising by about 10%, with 99.9% statistical significance. And now I want you to imagine your day trading, your swing trading returns doubling. Just because I checked an annual holding period doesn't mean that we're going to do annual trades. So that's the takeaway for stocks. The strategy can be optimized. It was rather trivial. The results were not a triviality. This is a remarkable finding for stock traders. The ability to double your average returns and see win rates go up about 10% is life-changing, if it's sustainable. So it's a remarkable finding for stock traders, and it should translate into truly remarkable finding for option traders, because options are levered. I said first I would motivate it with stock returns, it being return distribution characteristics. I did that. Then I said I would motivate it with win rates on option trades, it being return distribution characteristics. Then I said I would motivate it with win rates and returns on successful strategies that already exist in TradeMachine. Now, let me prove it to you. We just did the benchmark. Now, I'm going to show you a strategy that's in TradeMachine, Fade the Dip. It's also selling a put spread, but only when certain technical conditions are met. Okay? The win rates go from 60% to 75%. The average returns go from a loser to a winner, and the statistical significance is through 32 decimals. Now, I'm going to take a Fade the Dip and say I only want to do it in companies where the skew is positive and the same kurtosis, the 1-year kurtosis is greater than 1. Fade the dip with tail dynamics, 17% returns. So what happened? Fade the dip is a winner. This is the immense value of TradeMachine as it exists currently. Current TradeMachine members, you've been getting a lot of value with this strategy. But Fade the Dip with skew and kurtosis is a bigger winner. And this is the start of the immense value of TradeMachine's upgrade. Just the start. We've just begun. And then I said I would motivate it with win rates and returns on successful strategies already in TradeMachine. I did that too. I showed stock. I showed 3 option strategies. I could have filled 5 hours with the strategies that exist in TradeMachine and how they've improved. This is the second time in my 25-year career that I've seen what can be called a statistical anomaly, or even an aberration. An aberration is a departure from what is normal, usual, or expected. This is remarkable. Remember the stock trading strategy? That was a triviality. It could certainly be improved. The results were not a triviality. The option strategies were not a triviality. So TradeMachine tested strategies already. The results were also not a triviality. I want you to imagine now on your option trades, your win rates rising by about 10% with 99% statistical significance, and imagine your average returns doubling or tripling. That's the option takeaway. These are the takeaways. a doubling or a tripling over the long arc of trades. Alrighty, we're done with the video. Somehow that took me like 2 hours live and it took 8 minutes on a video, which is great. Now let's actually do it. We are going to go to TradeMachine. So when you first log into TradeMachine, let me check my time. Excellent. This is what it looks like. It's something called the Today tab. I'm actually not going to spend a lot of time on the Today tab. I wanted to show you how to build a portfolio of trades, but since I'm here, when you log into TradeMachine, you'll see in a grid certain strategies and all of the tickers that have triggered on the day for that strategy. And if there's a little AI lightning bolt by it, they also have our AI layered on top of it. For example, Atlassian today, ticker team, it triggered the spread, the sell-off, which is the strategy I'm going to talk about today. So if you just click on the ticker team, it'll take you to the backtest tab. We've gone from the Today tab to the backtest tab, and it'll show you how it's done over the last 3 years. Right? 8 wins, 2 losses, 118% return. If you're an annual member of TradeMachine, we call it a platinum member, but it's a fancy way of saying annual member. Not only do you get these triggers, but if you click the show options, you get live options data. So for annual members only, platinum members only, if you click show options, it'll actually show you what the back test is. This is a 1x3x2. I'll talk about that later, but these are the options. You'll get long these 3 options and short these 3. It actually tells you, it turns deltas into actual strikes. Like this is expiration and strike, this is the trade. Okay, now let's build this portfolio. Okay, I want to do the spread the sell-off. You can just pull it from a drop-down menu. If you're a TradeMachine member and you have your own strategies you like, you can have unlimited strategies. You have 300 strategies you like as an option trader, that's fine. It's too many, but do as you wish. There's no limit. If it says CML in front of it, that's our company, Capital Market Laboratories, then it's our pre-built ones. I want to do spread the sell-off. So I'm just going to, this is the effort. Ready? Click spread the sell-off and say load. Okay, it's going to load it. I'll just pick a ticker, it picks Amazon. I want to look over the last 3 years. I'll click the 3-year button. Okay. So whatever the strategy is, I'm going to talk about in a second. It's happened 6 times in 3 years for Amazon. It's 6-0, 117% return. Okay, great. Question is, okay, dude, what is the strategy? So the technicals are down here, but I find it way easier to look if I click on technical. Okay, so what is this strategy? Remember I told you it's for a bear market? So the stock has to be down at least 10% in the last 30 days. In Trader Talk, we call that a correction. Stock's in correction. And the stock has to be below the 200-day moving average, right? I consider a stock below the 200-day moving average in technical failure. So the stock's in correction and it's in technical failure, that's a bear market. The last 2 requirements are 2 of our AI requirements, okay? Something about the 6 months asymmetry and the 1-year tailedness, okay? Skew and kurtosis. Again, this webinar just doesn't have time to get into it, so I have to go a little bit quickly, but it's 2 technical, it's a stock movement requirement, a technical requirement, and 2 AI requirements, okay? That's what the strategy is. The next question is, okay, those things happen and it triggers a trade. What is the trade? So it's a custom strategy and you're getting long this put, short 3 of these, and long 2 of these. Rather than show it like that, let me show you what it looks like in a P&L. This is what the strategy does. Okay, the current stock price is right here, this long vertical line. If the stock goes up, it's fine. It's a profitable strategy. It's great. But it's actually designed if the stock's going down because your max gain is up here. The stock will go to this price to your max gain probably about 25% of the time. Okay. And you stopped out if the stock really collapses. So the stock's already down more than 10%. It's already below the 200-day moving average, and it has to go down even more. But yes, of course, the strategy can be a loser, and it's a loser if the stock really, really collapses. It's covered. There's no naked strategies here. So this is what the P&L looks like. Okay, stock goes up, you win a little. Stock goes down, you win more. Stock goes down too far, you stop out. That's it. That's a strategy. Okay. This is a particularly useful strategy in the last year or a couple of years because this is kind of what tech stocks have done. They go up not very often. They go down a little bit, and every once in a while they collapse and you want to get out. And when the market turns to bull market, this will still make money, and we have strategies for a bull market. Don't you worry. Now, I said a portfolio. This is not a portfolio. This is a stock. So I'm going to go to portfolios. Built into TradeMachine is all of these portfolios. NASDAQ 100, the Dow, financials, tech, utilities, basic materials, and you can add any portfolios you like. So right now I'm going to run this for the last 3 years, spread this off against the entire NASDAQ 100. And you can see how fast it's going with its computations. This is another benefit of being a platinum member, an annual member. You're getting 7 to 10 times faster backtest speeds. Another thing you're able to do if you're a platinum member, we allow up to 200 tickers in a backtest if you're platinum, 200, 200. If you're a regular member, a monthly member, you only get 50. So if you wanted to do the NASDAQ 100, you have to run the first 50, write it down, do the next 50. So this is the benefit of being an annual member. But of course, if you want to be a monthly member, by all means. So I'm going, this is a TradeMachine is now ripping through all 100 tickers. And remember what I said we were going to do. It's only interesting to me if it works for the entire sector first. In this case, the index. If it works for the entire index, then I'm willing to look for the best ones and start getting triggered. Okay. So TradeMachine's going through these tickers one by one. You can see some, names you're familiar with, like Lulu. Apple and Amazon are up there. Here's CrowdStrike. So just going to go. All right, it's done. Over the last 3 years in the entire NASDAQ 100, the strategy has an 82.5% win rate, and the average trade is 27%. That's in a little less than 30 days. Those are fabulous, fabulous returns. Fabulous, fabulous returns. But now, since it does work in the industry, now I only want the ones where it's done the best. So how do I do that? I'm gonna just sort by average trade. And my rule is there has to be at least one trade a year. So this is a 3-year backtest. I only want the ones that have an average return over 20%, and there's at least 3 trades, right? 3 years, I want at least one trade a year. So I'm literally just going to start clicking boxes. I'm going to skip Marvell. It's only one trade. Just keep going. You'll see some familiar names. For example, here's Illumina, 7 wins, no losses. Oops. I'm going to skip the ones where there's fewer than 3 trades. ADP. Ross Stores. Regeneron, Texas Instruments, 10 wins, no losses, 50% average return. Electronic Arts. Here's Biogen, 8 wins, 2 losses, 48%. Here's Qualcomm, 4 wins. Here is Atlassian Team, the thing that just triggered. Right. Here's AMD. It's happened 4 times in the last 3 years. Average trade was 40%. That's every time you did it. Okay. Here's Amazon. We knew that. 6 wins, no losses. All right. So I'm going to go up until the average trade return is 20%. And there has to be at least 3 trades. Okay. I'm going a little slowly on purpose so you guys can sound see that. Remember I said it was going to take effort? Well, this is the effort. Here's Google, by the way. It ain't that much effort. But this is creating a very structured plan, and I'll show you why. Okay, I think we're pretty much there. JD is a Chinese e-tailer. Okay, so these are the companies that have an over 20% return, and it's happened at least once a year over the last 3 years. Okay, so what do I do with these companies? I'm going to click Add Alert. This will take me to the Alerts tab. We were on the Backtest tab, we're now on the Alerts tab. Those tickers are right here. They're all put in. Okay. The technicals are already set. Stocks down by 10% or more in the last 30 days. Stocks below 200-day moving average, and our 2 AI measures. I'm going to write myself a little note. Spread the sell-off, just so I know when I get this notification. And, oops, I have to type over a microphone. And in parentheses, I'm going to put that this is the NASDAQ 100. So when I click Add Alert, if I were to put my phone number too, I could get a text or an email or both. And you'll see a message. It'll come in yellow quickly that I've just added these alerts. Click Add Alert. There it is. 41 alerts were created. I've now done all the work. I now no longer have to watch the market. For the NASDAQ 100, I've picked the 41 best companies for the strategy. I will get an email or a text when it happens. And when it does, I'll see the trade. That's it. That was it. That was the effort. If you want to see how these trades did, how these tickers did, since I just picked the 41 best, I put them on my clipboard. And let's just look at the 41 best. Again, this will go very, very fast if you're a platinum member, which of course I am. What TradeMachine is doing now is just exactly what it just did, but just those 41 tickers that we chose that were over 20% and traded at least once a year. Now we're looking at 90% win rate, average trade of 50%. over the last 3 years. That's the start of a portfolio. 2 parts of a portfolio. First of all, you need more than one strategy. I'm not going to do that on that webinar. I don't have enough time. What I will do is remind you that you don't just do one sector. Don't just trade tech, right? So let's do this exact same thing, okay? But I want to do it for financials. So I'm simply just going to click financials. That's it. That's the amount of effort I'm asking. And remember, if the entire sector works, then I'm 100% interested in adding the best. The check, 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 add it to alerts. I'll get a text message when it's time to trade. If the sector doesn't work, then I'm not interested, because if the sector doesn't work overall, then the fact that a company did well is probably just luck. It just, it's a roll of the dice. It's got to work in a type of company. And so I'm generally trading tech, financials, and healthcare. And that's also available in the portfolios. You can do whatever you want. Basic materials, utilities, whatever you like. Okay, so TradeMachine is going through this for the for financials, almost done. And this might surprise you, but financials are a better opportunity than tech. Remember, tech average return was like 27%. This is 30%. Win rate's even higher. So financials are unbelievably good. It's a whole new group of companies that can do the strategy. And I would sort by average trade, make sure there's at least 3, that the average return is at least 20%. I would do the same thing. I'm not going to do it, but you're going to get down and you're going to find some really great companies. You're going to find the JP Morgans of the world in here. You're going to find the Bank of Americas. You're going to find the Goldman Sachs, 8 wins, no losses, right? And all of a sudden, maybe you don't normally trade financials. Now you're diversifying your portfolio, right? It's not just tech, right? If tech's doing great, but financials are in a bear market, make money there, or vice versa. Right? Now, in the slideshow, I told you that we would do 4 strategies. This was spread the sell-off. Okay. The other one I told you was the pre-earnings diagonal. That's for a bull market. I did buy the sell-off. That's for a recovering market. And I did fade the dip with AI. I did a webinar with this. Did 100. You end up with 140 trades. Okay. We don't have time on this webinar to do it. But I did this exact same webinar November of last year, literally. And this is how it's done from November, the time of that webinar, through 2 days ago. 4 strategies. One of the 4 didn't do well over the last year. Of course, that's why we have a portfolio of option trades. Being bullish on tech, just straight down the middle bullish without some finesse, just hasn't worked. I'm not talking about mega tech. This is what happened. 90 wins, 29 losses, 76% win rate, 30% average return. A lot of it came from this because it's been pretty, even though the indices are going up, smaller tech has not been doing great, right? Spread the sell-off. But these also work great too. This is what a portfolio of trades looks like. This is why you do it. One of the strategies is probably not going to be doing great. Your worst strategy should not be worse than your best strategy. You should have far more wins than losses, even with your bad strategy. This is a portfolio of trades working over the last 9 months or the last 3 years or whatever you want. I say 11, 18, 20, 23 because that's you can see it. If you become a TradeMachine member, you can actually look it up on YouTube. I did the webinar for everyone to see. I showed everyone the trades for each strategy. And then we just waited and watched. This is the process part. Remember I said it takes a process or a plan. It takes patience, and then it takes effort. I've shown you the effort. This is what the process looks like. I did it for one strategy today with you. And I would have just done the same thing with that. I would just another drop down menu. I would just picked it from the drop down menu, picked a portfolio, let it rip. Same thing, same process. Would have been pretty repetitive. Since I'm here, before I take questions, something that goes great with TradeMachine is something called Pattern Finder. If you've ever wanted to see streaming AI on a chart, here you go. Okay. If I click the AI button, our AI is going to start pulling apart our algorithms inside the chart and start telling us what's going on. It's going to go really, really fast. So I'll let it do it and then I'll come back. Yeah. Okay. There we go. So it's looking at the up volume to down volume in the last 30 days and 50 days, looking at the last 4 weeks, the last 3 days, whether support, whether it's higher lows and lower highs, whether it's poked through support or resistance, tells you all of the congestion points, all of the congestion upside and downside, upside targets and downside targets. The bullish indicators, it's a whole trading plan by clicking a button. I tell you this because if you become a TradeMachine member, you can get Pattern Finder for $28. All right, let me go back to the slideshow. Okay. I showed you one strategy of the 4 that would make a portfolio. I showed you 2 sectors in my formal webinar, which is a little longer. I say you should have at least 3 sectors. You get to choose the sectors, it's up to you, but you should have at least 3 sectors for each strategy. Because while people like to talk about bull markets, bear markets, recovering markets, and falling markets, actually sectors move in their own world. Falling market's usually a bull market for utilities, for example. So you should be diversified. That's what a portfolio is. This is how you get the long arc of career of success. You don't just bet on tech. Okay. I showed you that there was statistical significance in that video with that fancy music. Told you what the takeaways were. I showed you the portfolio. And here's the offer for NinjaTraders. If you go to trademachine.com/ninja, trademachine.com for ninja, you can try it. It'll look like this. One of these pages. There we go. It'll look like this. If you really want to know more about backtesting, I didn't have time in this webinar. You can just watch a cool 6-minute video. It's very, very, it has nothing to do with TradeMachine. It has to do with just the idea of backtesting. You can learn more. This is the video I showed you, the AI video. You don't have to watch that. You can see some more details about the platform. You can see our testimonials. They're all real. If you click on it, it's a great feeling to be on the right side of the strategy. Click on it. Is that real? Yes, it's real. That was actually 2018. So we've been doing this for a long time. And here's your choice. You can go with Platinum, which is the most powerful version of it, and you can try for $9. Just click on this. It's $9. $9 for 9 days. You don't like it, you cancel. Canceling is really easy. It's in your account. You'll be in here. You'll go to your account. You go to subscriptions, and you'll click cancel. Don't have to worry. Our support team isn't going to trick you and make you wait 9 days and charge you $1,000. Don't worry. If it takes you 10 days to decide or 11 days to decide and you change your mind, just tell us. We'll refund you. The company doesn't make money off of traders who don't mean to have the software. We make a profit from traders who want the software. Okay. So I would recommend trying it for $9 for 9 days, because then you get the full boogie. You get to see all the speed and all of the full capabilities, all of the portfolios and live options. If you don't want to try the annual version, you can just go. I'm offering NinjaTraders a special price, $69. It's normally $209 for the month. Then you can just pay $69 for a month. You don't like it, cancel whenever you want. And then there's no you don't have to remember what's going to happen in 9 days. All right, so that is my as fast as I can go presentation. I hope you felt as though I honored you, honored your time. And if you want to ask questions, you absolutely can. I'm going to stop sharing my screen. It should go back to like a plain Ninja page. It does. I'll turn on my video so you guys can see that there's a real person here. Oh, the host will not let me. Sorry. Well, trust me, I'm really here. And if you have any questions, I'm happy to answer them. Is this full auto? It's fabulous. I don't know what you mean by is this full auto, but everything you're seeing is using historical data, and you saw the effort you have to put in. Basically, you have to take the time to click around. Like set it and forget it. No, not yes, set it and forget it in the sense that you put your alerts in, and then your email or your text or both, you'll get alerted if you set them. Put the offer page back on. Okay, I think this webinar ends in 1 minute, so I think I'm actually done. So I'm going to put the offer page back up. Oh, sorry. This is the address. I'm going to make it full screen. That was terrible. Sorry. There. Okay, that's it. It's trademachine.com/ninja. Okay, guys. So I was told I have 45 minutes. I have just hit minute 45. So I'm officially gone. TradeMachine.com/ninja. You can try it for $9. If you don't want to try it for $9, that's okay. I still wish you a very happy rest of your week, a fabulous weekend, and honestly, a fabulous rest of your lives, both in trading and everything else. God bless. Okay, guys. Thank you so much for your time.
And thank you, Ophir. Very much appreciated. Thank you for your time and sharing all that with us here today. If you did enjoy today's session, please you join us for future sessions. We would like to remind you that today's event and the information provided therein was that of Capital Market Laboratories and not of NinjaTrader. All information was for educational purposes and should not be construed as trading advice. Enjoy the rest of your day, and we hope to see you in future webinars. Happy trading from all of us here at NinjaTrader Ecosystem.